Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Okay, so basically what we've done, guys, is we pulled together a number of different combinations in order to capitalize on a particular objective or a particular directional view on our currency pair values. The important thing to recognize is that there are a multitude of strategies that you can very effectively implement using these FX options. You can buy calls and puts to trade your directional views. You can create debit spreads to lower your risk exposure on those directional views. You can create directional butterflies and condors to also capitalize on a particular directional view. You could write naked calls and puts to generate cash flow, putting the time depreciation and expensive options on your side. You can create credit spreads to essentially accomplish the same thing as the naked writes, only lower your capital requirements and identify your risk exposure. Finally, you can create these iron condors that I just showed in the last example to once again take advantage of what you believe to be a range-bound currency pair. And then if at the end of the day you believe there's going to be a big move in the underlying security, you just don't know which way, you can implement a straddle or a strangle. So at the end of the day, recognize that you have a number of different choices that you can make to trade your directional views. It all starts by, of course, analyzing your pair value charts and figuring out what your objectives are, and of course what your level of experience is and comfort level with some of these strategies. If you don't know, if you're not sure, then you need to educate yourself and, of course, understand the implications of each of these different strategies that you're looking to take advantage of. Just an example from one of the individuals suggesting that this has no use as the costs are much higher than the profit. Well, you know, unfortunately, I'm going to disagree with you in the sense that if you're creating if you're doing this with one contract, I could agree. In other words, your commissions are going to be somewhat detrimental to the position that you're creating. But at the end of the day, if we go back to this particular strategy here, let's take a look at the iron condor. My position here is only going to require me to pay out commissions at once unless I'm forced to manage the strategy within the lifetime of this contract. I'm going to see all of these options expire worthless. And I'm not just going to do one contract of each. I might do 10 contracts of each. So you have to also understand, and again, this comes all the way back down to my beginning suggestion, is that you have to look at what your objectives are, and you have to look at your account size and whether or not these strategies are going to be appropriate for you. But at the end of the day, if I'm doing 10 of these positions, 10 of these contracts, depending on the broker that you're trading with, my profits are going to far exceed the costs of me implementing this strategy, and I'm only going to have to pay commissions on one side of it, because if I position myself correctly, everything's going to expire worthless. In fact, in the iron condor, one side is always going to be expiring worthless, which means we may have to pay commissions on two sides to get in, but one side ultimately is always going to expire worthless, because if, in this case, the CDD is above 107 on expiration, all of my puts are going to expire, and vice versa. If the CDD is below 104 at expiration, all of my calls are going to expire worthless, so I'm not going to have to manage that position. So certainly a very good point in the sense that if you're only doing one contract of each of these, then commissions might be a burden, and your cost of doing this strategy might be a challenge. But I don't know, and in fact, maybe just to backtrack, you might be referring to the cost of being this number right here. That actually, in brackets, represents a commit or a credit to your account. So anything that you see here in brackets is in fact a credit. and that credit is seen as a full profit on expiration. So maybe I misunderstood your question or your observation, but ultimately anywhere where you see a bracket in red, that is a credit into our account. Okay, and when we're looking at our profit and loss, it's here where we recognize the full profit, and here where we recognize the loss. Okay. Now another question here. Can we explain again what the underlying is? What if you wanted to take a long or short position in the underlying after putting an option on an option trade? Could you? No, as I mentioned earlier on, and again, we have, if you want a little more, I'll explain in brief, Barb, just to give you some insight. But when we're looking at, remember, this is a strategy-based webinar, so we didn't take a lot of time to explain what the underlying is. But the ISC FX pair values are essentially established by the spot market value of the U.S. dollar, in this case the CDD, versus the Canadian dollar. So if you want to trade your value or your views on the currency without trading the spot market, we're going to use these ISCFX options to do so. So in the case of the underlying is, there is no underlying. We're looking at a notional index. So the chart here that we're looking at is essentially an index that is plotted based on the spot market value of the Canadian dollar times 100. And there are no shares that trade on this on the CDD. So the index is simply used as a way to price the underlying options. So as a result, we can't do a covered call strategy because we can't buy underlying shares of the CDD and then sell call options. So every other option strategy that we would consider implementing, we could do except for buying the shares and buying and selling the calls, or buying the shares or buying a put, or shorting the shares and buying a call. Anything that we would look to typically to do in the equity markets, we can't because this is a notional index. But any option strategy that we could ever think to utilize alternatively, we can implement.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.